Today we are going to discuss about when and how to adjust value-added tax relating to bad debts in value-added tax returns. It means, when you supply goods or services, raise an invoice and the customer fails to pay even after 6 months from supply, then that can be shown as bad debt and adjust the value-added tax records accordingly. One should comply with the following to adjust as bad debt. Number 1. Goods and services shall be supplied and the value-added tax shall be charged and accounted. It means, the supplier should physically supply the goods or provide the services to customer and that the value-added tax charged on tax invoice should be paid by supplier to federal tax authority in that relevant tax period. Number 2. More than 6 months has passed from the date of the supply. It means, the debt should be remained unpaid for a period of 6 months from the date of supply. In other words, the supplier cannot declare the debt as bad and cannot take the adjustment for value-added tax in the value-added tax return within 6 months from the date of supply. Number 3. Supplier shall notify the customer about written off of the invoice. It means, the minimum information to be notified to customer when the supplier writes off the invoice are, point number 1. The invoice number and date of the tax invoice which has not been paid by the customer, and point number 2 is the amount of consideration that has been written off by the supplier. There is no specific method through which a notification can be made to the customer. Supplier can send the notification via letter, email, post or any other similar communication to the customer stating that the amount of consideration has been written off. It is not necessary for the supplier to receive any acknowledgement from the customer before taking bad debt adjustment. However, the supplier needs to evidence the documentation and that the best measures were taken to notify the customer. Number 4. Supplier shall update the accounts and value-added tax returns with bad debts. This means the supplier has to write off the whole or part of the consideration for the supplier as a bad debt in its accounts. It is important to note that the bad debt relief can only be taken to the extent of the consideration written off in the accounts. Therefore, if only a part of consideration is written off, a bad debt relief can be taken only to the extent of such written off consideration. Now we will look into how to adjust the value-added tax on bad debt in the value-added tax return. You have to keep in mind that any adjustment on account of bad debt relief should be made in the adjustment column of box 1 of the value-added tax return. The adjustment amount should be the value-added tax amount only and should be reported for each emirate, where applicable, in accordance with the respective output tax amount being adjusted. Here is an extract from value-added tax return template for your reference. If you are not claiming value-added tax bad debt relief or making a real estate adjustment, you should not include anything in the adjustment column. Thank you for watching. We are here to help you address any type of query pertaining to value-added tax or economic substance regulations or anti-money laundering or anything to do with your audit or any accounting issue, or if you need business advice. You can email us on info@spectrumaccounts.com or call us on +9 71426999329, and you can also visit our website at www.spectrumaccounts.com.